Hello, welcome to Capital Sensei. Today we're going to dive deep into one of the most transformative investing books ever written, The Education of a Value Investor by Guy Spier. We'll follow Spier's incredible journey from a morally corrupt, high-pressure Wall Street environment to becoming a disciplined, thoughtful, and successful value investor in the mold of Warren Buffett. We'll unpack the critical lessons he learned about mastering your own psychology, the immense power of your environment, and the practical tools you can use to avoid common investing mistakes. Here at Capital Sensei, we believe in the power of a learning community. Whenever we can, we answer questions in the comments. So as you watch, if any questions pop into your head, or if you have your own story about trying to become a more rational decision maker, please share it below. Your experiences and doubts help everyone learn and grow together. To truly understand the power of Guy Spier's transformation, you first have to understand where he started. Picture this: a young man, sharp as a tack, fresh out of the most prestigious schools in the world, Oxford and then Harvard Business School. He felt, by his own admission, that the world owed him something. He was armed with elite credentials and a burning desire to make a lot of money fast. He was the very definition of someone driven by what we call an outer scorecard, seeking validation through money, status, and the approval of others. His first real job out of business school was at a firm called D.H. Blair. Now, this wasn't your typical Goldman Sachs or Morgan Stanley. D.H. Blair was what's known in the industry as a bucket shop or a boiler room. Think of the movie The Wolf of Wall Street. It was an environment of extreme pressure, questionable ethics, and a relentless focus on generating commissions, often at the direct expense of the clients. The entire business model was designed to exploit human psychology. Brokers were trained to create a sense of urgency and fear of missing out, pushing speculative, low-quality stocks onto unsuspecting investors. It was a place where greed was good and long-term thinking was for suckers. Spier was caught in this machine, and it began to warp his own sense of self. He was doing things he knew were wrong, but the environment made it feel normal, even necessary for survival. Imagine you're trying to eat healthy, but you've decided to live and work inside a donut factory. The smell of sugar is constant. Your coworkers are all eating donuts, and your boss's main job is to convince you that donuts are a health food. No matter how strong your willpower is, eventually you're going to start eating the donuts. That was Guy Spier's world. He was in an environment perfectly designed to bring out the worst in his decision-making. He was miserable, feeling like his soul was being corroded day by day. It was in this state of personal crisis that he had his epiphany. He stumbled upon the writings of Warren Buffett. Reading about Buffett was like opening a window in a smoke-filled room. Here was a man who was unbelievably successful, yet he operated from a completely different universe of principles. Buffett wasn't about high-pressure sales or speculative frenzy. He was about calm, rational analysis, patience, and above all, integrity. Spier began to devour everything he could find about Buffett and his partner, Charlie Munger. He discovered the philosophy of value investing. Now, what is value investing at its core? It's actually a beautifully simple idea. It's the art of figuring out what a business is truly worth, its intrinsic value, and then only buying it when its price in the stock market is significantly lower. Let me give you an analogy. Imagine you're an expert on vintage cars. You know every model, every engine, and what they're worth. One day, you walk past a garage sale and see a dusty, slightly neglected 1965 Ford Mustang. The owner just wants to clear out his garage and has a sign on it for $2,000. Because of your expertise, you know that with a little cleanup, this car is easily worth $30,000. Buying that car isn't a gamble. It's an investment based on a gap between price and value. That's value investing. This was a revelation for Spier. His job at Blair was all about guessing which way the stock price would move in the next week or month. Pure speculation. Buffett's approach was about understanding a business so well that you could confidently say what it was worth, independent of its fluctuating stock price. It was a shift from being a gambler to being a business owner. This discovery gave him the courage to quit his toxic job and embark on a new path. A path to re-educate himself from the ground up. The first and perhaps most crucial lesson Spier learned was the overwhelming importance of his environment. He recognized that his own willpower was not enough to overcome the toxic influences of Wall Street. The constant noise, the pressure to perform in the short term, and the culture of greed were simply too powerful. He needed to make a radical change. So what did he do? He moved his family and his budding investment firm to Zurich, Switzerland. Why Zurich? It wasn't random. He chose Zurich precisely because it was the opposite of New York City. It was quiet, calm, and most importantly, thousands of miles away from the frenetic energy of Wall Street. He intentionally created an environment of isolation. By removing himself from the daily chatter and the pressure to follow the herd, he gave himself the space to think clearly and independently. Think of it like this. If you want to write a great novel, you probably wouldn't set up your desk in the middle of a loud, chaotic amusement park. You'd find a quiet study, a cabin in the woods, a library, somewhere you could focus without distraction. Spier did the equivalent for his investment mind. He understood that our decisions are profoundly shaped by our surroundings, far more than we like to admit. He was building a fortress of solitude to protect his rationality. This move wasn't just about geography, it was a complete restructuring of his life. In New York, he was constantly bombarded with stock tips, market gossip, and the latest hot trend. In Zurich, he had to rely on his own research, on reading annual reports, and on forming his own conclusions. This forced isolation was the fertile ground where his new investing self could begin to grow, free from the weeds of external influence. This leads directly to the second major pillar of his education, embracing the inner scorecard. This is a powerful concept he learned from Warren Buffett. Buffett once asked, "Would you rather be the world's greatest lover, but have everyone think you're the world's worst lover? Or would you rather be the world's worst lover, but have everyone think you're the world's greatest?" It's a funny question, but it gets to a profound point. Which scorecard are you living by? The outer scorecard is based on what other people think of you. It's your job title, the size of your house, the car you drive, your follower count on social media. This is what drove Spier at Blair. He was obsessed with the appearance of success. The problem with an outer scorecard is that it makes you a puppet. You're constantly dancing to the tune of others' expectations, and you're vulnerable to herd behavior because you crave external validation. The inner scorecard, on the other hand, is your own internal set of metrics. It's about integrity, intellectual honesty, and adherence to your own process. For an investor, the inner scorecard isn't about whether a stock went up or down this quarter. It's about asking yourself, did I do my homework thoroughly? Did I act rationally and without emotion? Did I stick to my principles, even when it was difficult? Did I learn from my mistakes? Imagine a master carpenter. The outer scorecard is a customer saying, "Wow, that table looks great." The inner scorecard is the carpenter knowing deep down that every joint is perfect. The wood was chosen with care, and the finish was applied with masterful patience, even in the places no one will ever see. True, sustainable success comes from focusing on that internal quality, not on external applause. Spier realized he had to stop trying to look smart and start focusing on being smart, which often means looking foolish to the crowd in the short term. Spier was brutally honest with himself. He knew he wasn't a natural-born investing genius like Buffett. He was prone to the same emotional and psychological biases as everyone else: greed, fear, envy, overconfidence. So he came up with a brilliant strategy. If you can't be a genius, you can at least copy the habits of geniuses. He embarked on a mission to clone the best investors, particularly Warren Buffett and his friend and fellow value investor, Monish Pabrai. Now, cloning doesn't mean blindly copying their stock picks. That's a recipe for disaster because you don't know why they bought it or when they plan to sell. Instead, it means deconstructing their thought processes, their daily routines, and their decision-making frameworks. It's about reverse engineering their success by adopting their behaviors. For example, Buffett is famous for spending the majority of his day just sitting and reading. So, Spier structured his own day to include hours of uninterrupted reading. He reads company reports, industry journals, biographies, science books, anything that can broaden his understanding of the world and how businesses work. He turned himself into a learning machine, just like his role models. Another key part of this cloning process was adopting the use of checklists, an idea heavily promoted by Monish Pabrai, who himself was inspired by the surgeon and author Atul Gawande. Why a checklist? Because our brains are unreliable, especially under pressure. When we get excited about a potential investment, our brains are flooded with dopamine, and we start to see only the good things. We develop tunnel vision. A checklist is a simple tool to force you to slow down and be systematic. It's the pilot's pre-flight checklist for investing. Before buying any stock, Spier goes through a rigorous list of questions he has developed over years. Questions like, is this business within my circle of competence? Meaning, do I truly understand it? What is the company's competitive advantage? How could this investment go horribly wrong? Am I feeling a sense of FOMO, the fear of missing out? Is the balance sheet strong? This process isn't about finding reasons to buy. It's largely about finding reasons not to buy. It introduces a dose of mandatory pessimism into an otherwise overly optimistic process. It's a way of outsourcing discipline, of building a system that protects you from your own flawed human nature. By cloning the habits of the greats, Spier built a framework that allowed him to operate more rationally and consistently than his natural instincts would allow. Building on this idea of creating systems to manage his own psychology, Spier developed a set of personal rules or investment tools designed to keep him out of trouble. These rules are the practical, on-the-ground application of his philosophy, and they are pure gold for any aspiring investor. Some of them sound completely counterintuitive at first, which is exactly why they are so powerful. Let's start with one of his most famous rules. As a general policy, do not talk to the management of companies you are thinking of investing in. Wait, what? Isn't that what analysts are supposed to do? Go meet the CEO? Get the inside scoop? Spier argues this is a terrible idea for most investors. Why? Because CEOs are by their very nature master salespeople. They got to where they are because they are charismatic, persuasive, and eternally optimistic about their company's future. If you meet with a charming CEO, you are highly likely to be swayed by their personality, not by the objective facts of the business. This is known as the liking bias. We tend to agree with people we like, regardless of the merits of their argument. Spier decided to level the playing field. He would only analyze companies based on their public filings, the 10Ks, the annual reports, and other verifiable objective data. It's like judging a used car based on the independent mechanic's report, not on the glowing sales pitch from the owner. Another crucial rule is do not talk about your current investment ideas or holdings. This is another one that seems backward. Don't we want to share our brilliant ideas? Spier says no. The moment you publicly state that you own stock X, your ego gets tangled up in it. It's no longer just an investment. It's a reflection of your intelligence. This triggers what psychologists call commitment and consistency bias. We feel a deep-seated need to remain consistent with our past statements and decisions. If the facts about the company start to change for the worse, it becomes much harder for you to sell because you would have to admit, both to yourself and to others, that you were wrong. By keeping his investments private, Spier gives himself the mental freedom to change his mind without any ego-driven friction. It allows him to assess the situation with cold, hard logic. Then, there's the rule that we could all probably use in many areas of our lives. If you've done all your research and have decided to buy or sell a stock, force yourself to wait 48 hours before placing the trade. This is a mandatory cooling off period. Investment decisions are often accompanied by a rush of emotion, excitement for a purchase, panic for a sale. This 2-day rule allows that initial emotional wave to subside. It gives your rational brain a chance to catch up and ask, is this really as good an idea as I thought it was 2 days ago? Often, after the adrenaline has faded, you might see a risk you overlooked or realize your initial thesis wasn't as robust as you thought. It's a simple but incredibly effective circuit breaker against impulsive actions. These rules, and others like them, form a comprehensive system. They are not about finding the next big winner. They are all about avoiding stupidity. Spier, like his mentor Charlie Munger, realized that a huge part of being a successful investor isn't about making brilliant moves, but about consistently avoiding common, predictable errors. His education was about learning his own weaknesses and then building a fortress of rules and processes to defend against them. Perhaps the culminating event in Spier's education was something truly extraordinary. In 2008, he and his friend Monish Pabrai pooled their money and made a winning bid of $650,100 in a charity auction. The prize? A private lunch with their hero, Warren Buffett. For them, this was the ultimate opportunity to learn from the master in person. So, what earth-shattering stock tip did Buffett give them? What secret formula did he reveal? The answer is none. And that was the most profound lesson of all. When they met Buffett, they weren't met by a secretive financial wizard jealously guarding his secrets. They were met by a warm, grandfatherly man who was completely authentic, generous with his time, and genuinely happy to share his wisdom. Spier saw firsthand that Buffett's public persona was not an act. He truly lived and breathed by his inner scorecard. He was comfortable in his own skin, driven by a passion for business and a genuine desire to teach. The biggest takeaway for Spier wasn't about finance at all. It was about life. Buffett talked about the importance of gratitude, of surrounding yourself with people you admire, and of giving back. Buffett explained that ultimately, the measure of a successful life is whether the people you hope love you actually do love you at the end. This shifted Spier's perspective dramatically. He realized that the goal of investing wasn't just to accumulate a pile of money. The true goal was to structure his life and his work in a way that allowed him to be a better husband, father, and human being. Wealth was simply a byproduct of a life lived with integrity and rationality. The lunch confirmed everything Spier had been learning. The secret to Buffett's success wasn't a complex algorithm. It was his character. It was his unwavering rationality, his humility, and his profound understanding of human nature, starting with his own. Spier left that lunch not with a hot stock tip, but with a new understanding of what it means to be truly wealthy. It was the final and most important piece of his education. So, after all this transformation, who is the Guy Spier of today? He is the antithesis of the man who started at D.H. Blair. From his quiet office in Zurich, he manages his Aquamarine Fund with a calm, methodical, and process-driven approach. He has successfully designed a life that minimizes emotional turmoil and maximizes rational thought. He has, in essence, tamed the beast of his own psychology. The goal is no longer to be the smartest, quickest, or most aggressive investor in the room. The goal is to be the most rational. This often means doing nothing for long periods, patiently waiting for that rare opportunity where the odds are overwhelmingly in his favor. That proverbial $30,000 Mustang on sale for $2,000. It requires immense patience and a complete disregard for what the rest of the market is doing. This entire journey, the education of a value investor, is not a story about how to get rich quick. It is the story of a man who undertook a deep and at times painful re-engineering of his own mind. The education of the title isn't the one he received at Harvard. It's the self-education in humility, self-awareness, and emotional discipline. It teaches us that the stock market is, first and foremost, a mirror. It reflects back at us all of our own cognitive biases and emotional flaws. The greatest challenges an investor faces are not in financial statements or economic forecasts. They are in the 6 inches of space between their own ears. By understanding this, Spier was able to turn investing from a source of stress and moral conflict into a craft that reinforces the best parts of himself: patience, lifelong learning, and integrity. Ultimately, the story of Guy Spier offers a powerful and timeless message. Success in investing, and arguably in life, is less about what you know and more about how you behave. It's about recognizing that you are your own worst enemy, and then having the wisdom to build systems, rules, and an environment that protect you from yourself. It's about shifting your focus from the chaotic noise of the outside world to the quiet, steady cultivation of an inner scorecard. Guy Spier's journey proves that you don't have to be born a Warren Buffett. You can, with conscious effort and humility, educate yourself to become a more rational, more effective, and ultimately a more serene investor.